Hi, welcome. Thanks for watching and I appreciate you being here. This video is a quick video about the 4 pillars of investing. I wanted to talk about the 4 pillars and also how I apply them to my life. In this video, I'm going to talk about the background of the 4 pillars themselves, and like I said, I'm also going to talk about how I apply them and use them to build the best portfolio possible. But first, here's a little bit about me. Hi, welcome to my channel and I'm glad to have you here. Here's a little bit about my family. Our household consists of myself, my husband, and my toddler. My mom also lives with us, but she's not included in our finances. My husband and I both went to graduate school, but we no longer have student loan debt, fortunately. I work in banking and he works in aviation. I handle all of the family's finances and I love my role as the self-appointed CFO. I love talking about all things money, making money, saving money, investing money, and optimizing my portfolio and my finances in general. I look forward to taking you on a wealth building journey with us. I hope you enjoyed the videos and the channel as a whole, and I look forward to getting to know you. I am very open, so feel free to send me messages at any time or starting conversations in the comment section below. There is this book called The 4 Pillars of Investing: Lessons for Building a Winning Portfolio. It is a book by a man named William Bernstein. William Bernstein is actually a trained neurologist turned personal finance expert or researcher in the field of modern portfolio theory. He is also a financial advisor. In this book, he outlines in plain language what he calls the 4 pillars of investing. His goal is to help investors manage their assets in ways that will help them build wealth over time. According to Mr. Bernstein, or should I say Dr. Bernstein, the 4 pillars are the theory of investing, the history of investing, the psychology of investing, and finally the business of investing. His argument is that in order for you to build the best portfolio possible and essentially not get hosed down, you have to understand how these 4 pillars work together in the world of investing. Let's tackle them one at a time. First is the theory of investing. In the theory of investing, he stresses the importance of understanding how risk and returns are related and how you can reduce risk. According to the book, and really not just the book, both by what we've observed and by what the studies have shown, the best way to reduce risk is with time and diversification. He also stresses that it is very important for people to understand that the past does not guarantee results, and that is good or bad results. Just because the market has performed poorly for a couple of weeks, a couple of months, or a couple of years, it doesn't mean that it's always going to perform poorly. But just because it has had a very good run, it doesn't mean that it's going to last either. You have to prepare yourself for the ups and downs, and the best way you're going to smooth out that volatility is by being invested for a long time and across a broad set of different asset classes. He also talked about how fund managers cannot consistently beat the market, and studies do confirm that. Most fund managers are not able to beat the index. Depending on what study you look at, it's anywhere from 85 to 95% of fund managers that underperform the index. The book says that indexing is the best way to get results with the least amount of effort and the least amount of costs. How do I apply this to my life? Well, first, I need to understand my own risk tolerance and I invest accordingly. In my case, I am diversified, but I don't have as many fixed income assets because I do have multiple streams of income. I have rentals, I have relative job security. I mean, nothing's guaranteed, but it's as close to security as I am going to get. I also have enough in savings to carry me through a rough patch, and I have room to cut in my budget if I really needed to tighten my belt. But at the same time, I still do index investing because I want to avoid panic selling, and I also want to reduce the likelihood of having single stock exposure. I fully understand the relationship between returns and risk, but I also know that I am going to be invested over a very long period of time. Even though I'm mostly invested in stocks, I do it through an index because I want to make sure that I am diversified across most of the stock market to avoid being in a situation where I lose a significant portion of my portfolio because a stock like Netflix or Teladoc drops 40+% in just a matter of days. The second theory of investing is history. If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good, and of course subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. Even though he says that past performance is not indicative of future results, he does say that we should use past incidents as lessons to avoid making mistakes in the future. For example, we have to understand the concept of irrational exuberance. That is when investors are so enthusiastic about either the stock market as a whole or a specific stock that it drives asset prices higher than their true value. It's not about predicting the future, but it's about having a little bit of insight so you can rein yourself in. Two great examples of that would be the dot-com bubble or the great financial crisis. And while this book was written more than a decade ago, so that means it wasn't updated with something like COVID, it would have been very easy for people to panic during COVID and be under the impression that we are never going to recover from this because there's a global pandemic. Even though it was our first pandemic in 100 years, it wasn't the first pandemic. There was the Spanish flu. We have survived 2 world wars. We have survived the Great Depression. The economy keeps on chugging. The recovery doesn't always look the same. Not the same people recover, not the same asset classes recover, but at the same time, there remain opportunities for lessons, either things that we need to change or things that we've done well and that we should continue doing. In my case, I use that history to understand that I cannot time the market. I can't predict the highs and I can't predict the lows. A lot of people feel like they have predicted the bottom of the market, but if you say something enough times, eventually it might come true. That's why there's the joke that says that economists have predicted 100 of the last 2 recessions. If you say it's gonna happen every year, eventually it will happen. It doesn't mean that you're right, it just means that you got lucky because you didn't know when it was gonna happen and you didn't know when it was gonna end. My goal is to not try and time the market, is to be consistent. I don't try to predict and I do my best to avoid a doomsday type of mentality. But it doesn't mean that I don't prepare because I use COVID as a lesson. How many people instantly lost their jobs when the lockdowns happened and they lost their income? I have to make sure that I have enough liquidity, enough in emergency savings to pay my bills and take care of my family. I also make sure that I'm not over leveraged because house prices can come down and I would hate to be underwater. The great financial crisis and the great recession with the subprime mortgage crisis was a lesson in that. I try to be a student of history, but I use that history to try and make decisions to insulate myself as best as I can, but not necessarily to pretend that I can predict or forecast what the market will do on a specific day and time. I ignore the noise and just keep investing. The third pillar is psychology. I would be shocked if a neurologist didn't consider the psychology of investing. And of course, as expected, he did. He says that we have to understand the various concepts of behavioral economics. Things like herd mentality, overconfidence, recency bias. Recency bias means that, hey, this is what happened last year, so this is what's going to happen again. Or this market or this stock has performed a certain way over the last 6 months, that's exactly what's going to happen again. Also, there's sometimes this need for excitement when it comes to investing. People feel the need that it has to be exciting and they think that if it's boring that they're doing it wrong. The concept of get rich slowly doesn't really elevate their heart rate as much as they would like, I guess. Investing isn't supposed to be exciting. If you want excitement, go to the casino. That's what gambling is for. It is very rare that you find something that is super exciting but also is going to make you money. You have to remember that most of the excitement really comes from the possibility that you might lose money, and I don't think it's worth it. There is also loss aversion. When we lose money, it feels much worse than if we gain the same amount of money. So we have this tendency to get emotional and react poorly if we see that our portfolio is down a little bit. Understanding these concepts will help you to prevent them because you'll be able to detect them as they are happening, or if they have already happened, you're going to catch yourself and you're going to try and correct yourself. Before I go into how I use my knowledge of the psychology of investing and apply it to my life, I'm going to read off a definition of behavioral economics. Here's what it says. Behavioral economics studies the effect of psychological, cognitive, emotional, cultural, and social factors on the decisions of individuals and institutions and how those decisions vary from those implied by classic economic theory. With that bit of information, here is how I use the psychology of investing investing in my own life to optimize my portfolio and to protect my assets. The most important thing for me is self-awareness. I have spent a long time building my self-awareness, in part due to my many years in being in therapy very regularly. I have been going to therapy now for almost 20 years, since I was a teenager, and it has done wonders in helping me know what my anxieties are about a lot of things. And I do happen to have a lot of anxiety about money. Being able to recognize those anxieties, as well as the sources of said anxieties, allows me to make plans that are both financially and mentally healthy. So I make plans that are good and that are strong financial plans, but I do everything that I can to avoid giving into my worst impulses. For example, I have this very irrational fear of being destitute, so I have this tendency of hoarding money. And having too much cash in your portfolio, especially when you are in the accumulation stage like I am and you are so far out from retirement, you are putting yourself where inflation is eating away at your purchasing power. So rather than feeding into that fear, I sat down and I made a very detailed and fact-based emergency fund. It not only accounts for the potential for job loss, but it also covers my deductibles and major repairs or even car purchases. And once I reach a reasonable number that I'm comfortable with and that in my mind, intellectually, I understand it is more than sufficient to carry me through most foreseeable emergencies, I decide that it's okay for me to go out and invest the rest of it, or even maybe enjoy the rest of it. I also make a commitment to myself, and I use my therapist as my accountability partner to make sure that I do not keep moving the goalposts. Once I reach my number, the only reason why I should be changing it significantly is if I have a major event in my life. For example, when I had a child, I decided to bump up my emergency fund a little bit. And then once my child started going to daycare, I had to bump it up further because I wanted to be able to cover the cost of daycare if one of us lost our job. Because without doing that specifically, I ran the risk of continuously moving that emergency fund goalpost where it would never be enough. Eventually, it would get to 100,000, 150,000, and 200,000, and it would never be enough because I have this irrational anxiety about never having enough cash on hand. I will never need $100, $150, or $200,000 in cash all at once. There is a point where I start harming myself financially by not putting that money in the market and missing out on those returns. I also make sure that I do index fund investing to avoid FOMO and overconfidence. I'm not even going to break those down because they're not unique to me. I think it is human nature to feel like you are missing out on an opportunity if everybody else is making money off of it, or at least if they claim they're making money off of it. Also, we like to think of ourselves as being smart and capable, and I'm sure that most of us are. But just because you're smart doesn't mean that you can predict the market. Being smart doesn't make you a fortune teller. And even if you are the best in your field, that doesn't necessarily make you an analyst or an adequate fund manager. The best cardiologist in America doesn't necessarily understand fundamentals of the market. We can be smart and capable in our own ways without knowing what the market is going to do for the rest of the year. In fact, I would argue that part of being smart is acknowledging the things that you do not know. I also invest in an index to avoid risky bets because I know that I suffer from a huge case of loss aversion. If I invest in an index, the index is investing in the market and not necessarily in a particular stock, not in a particular company. If the company starts slipping, it will eventually go out of business and be replaced by another one. But if I invest in a specific company and that company starts slipping, I am going to get very nervous and I am much more likely to lock in my losses because I don't like watching that stock slide. Market declines for me are a lot easier to stomach when I'm looking at an index because I know that a really bad company over the course of several years is not going to last very long in the S&P 500. The same cannot be said for a single company stock because I may not have the time to sell it before it goes to zero. And finally, I do a lot of affirmations and positive reinforcements, and I use some of those elements in my investment policy statement to keep my long-term goals in mind and to avoid panic from short-term swings. For example, I remind myself that retirement is many decades away, that my son doesn't go to college for another 16 years, and while different companies go out of business every day, the market as a whole will keep chugging, and as long as I'm in an index, I will always be okay in the long run. And finally, the business of investing. In the business of investing, the message is to remember that there is no free lunch. Services cost money. Those companies that you trade with, those companies that you invest with, the fund managers, they don't work for free. And that Uncle Sam wants his cut. There are commissions that you have to face. Funds have expense ratios. If you are trading a mutual fund, on a platform that is not the initial fund manager, you may have to pay a mutual fund fee, and taxes on profits impact overall outcome. That wasn't explicitly stated, but I would like to give some additional examples of my own based on lessons that I've drawn from recent events. Arguably, I would say that there are indirect costs that are associated with things like bad or unreliable service or limited functionality or even unethical practices. Let's not forget Robinhood's GME incident where they just went ahead and turned off the buy button. Of course, now there's Cash App that does trading, but it also has limited tickers. That limits your opportunity to invest in a broader set of asset classes. I was looking for an ETF on Cash App the other day and I couldn't find it. I don't invest in Cash App, I only use it as a peer-to-peer transfer option. But when I saw that they had a trade option, I was curious to see what it was all about. And of course, I took a look at it and it was relatively subpar. I mean, I'm glad that they're trying to democratize the process and give more people access to it, but really in the long term, that's not sustainable and that's not where you want to be. So how do I make the business of investing work for me? Well, I have a brokerage that is owned by a parent company with a long-standing reputation. They have $0 commissions and they have the ability to offer most services because they are very sizable and the economies of scale works in their favor. I'm also cognizant of the fact that I have to use ETFs in order to avoid mutual fund fees, and I have a tax strategy, both short-term and long-term. That way, that allows me to optimize my taxes, not just for now, but also later. For example, both of us max out our traditional accounts in an effort to lower our taxable income right now. We also max out our Roth IRAs because that allows us to hedge. We don't know what the future holds and we don't know what tax rates are going to look like. If they are going to be more expensive, it's good to have a hedge, and that's what we use the Roth IRA for. We are also building up our taxable account these days because we want to be able to access money in case we decide to retire before the age of 59 and a half, and we can use that taxable account as a bridge before we get to the age where we are able to withdraw from those tax advantage accounts without penalties. I also got out of advisory services in order to save money. I have more time to dedicate to my finances. I have built up my confidence as an investor. I feel like I have more knowledge now that I did several years ago. I don't really need to pay somebody 50 basis points or even 30 basis points to tell me what to do with my portfolio. And I do everything that I can to make sure that I protect my returns, and in part that includes not paying an advisor to tell me things that I already know. I used to have Merrill Lynch guided investing. I no longer have that program. If you want to check out my experience with that, I also made a video on the topic. I also avoided a whole life insurance scheme. I have life insurance, but anything more than term is not worth the effort to me. I encountered somebody who applied some high pressure sales tactics, but ultimately I decided that it wasn't for me. I have no problem with life insurance, but I think that whole life doesn't fit most people. And I am in that most people category where whole life just simply does not work for me. And finally, I'm also very mindful of expense ratios because I make sure that I buy cheap funds. Even though I'm buying ETFs, I'm buying Vanguard ETFs, I'm buying State Street ETFs to make sure that I'm keeping those expense ratios at 10 basis points or below. Ideally, most of them are between 3 and 5. And both my husband's employer and my employer, I'm actually paying about 0.02% on some of the funds that we have in our 401ks. Because remember that when it comes to building wealth, it's not just about how much money you make, it's also about how much money you keep. So avoid unnecessary taxes, avoid penalties, avoid high expenses. Always shop for a lower cost option and shop for value because cheapest isn't always the best. I don't mean to pick on Robinhood, but they're one of the first people that offered free trades to everybody, and look what they did. So free isn't always best. We also have to look at quality, but when two things are comparable in quality, definitely try and go for the cheaper one if you can. All right, so that's it for the video. I hope you enjoyed my rambling, but before you go, I want to hear from you. Have you read the book? How did you like it? And whether or not you read the book, did you hear about the 4 pillars? If so, do you apply them to your life in any way, and how? And am I missing anything important? Is there anything that you saw in the book that I didn't mention if you read it? Whether or not you read it, that doesn't matter. Do you have your personal opinions on those pillars? I want to hear them. Leave me a note in the comment section below, and I look forward to hearing from you. I will see you in the next one. I would like to continue sharing my thoughts on all things money with you. So I would appreciate it if you could help out the channel by liking this video and sharing it with anyone you think might benefit from it. If you want to see more content, be sure to subscribe and hit that notification bell so you can know when new videos come out. I'll see you in the next one.